Good afternoon, everybody. So this is the session where some of the more outlandish ideas are floated, and hopefully that will help you fight jet lag if that's the wrong time for you. The title of the session is, as John mentioned, Future of the International Monetary System. Before we go into the subject, let me, if I can find the right key. Okay, well, let me start with maybe asking why are we talking about this at all? I mean, after all, the international monetary system is one of the few things that didn't get broken in this crisis. And as I think Laura said earlier, if it's not broken, why fix it? Well, the answer to that is that a number of high-profile policymakers have expressed the opinion that, well, maybe it's not broken, but it's really not working well at all. So that would be reason number one, and that's, for instance, the viewpoint of Governor Zhou of the People's Bank of China, or the UN Commission chaired by Joe Stiglitz. But also there's been a number of voices who have said, well, yes, okay, it's not broken, but it's really just a matter of time. So we'd better do something about it before it falls apart. So there's, in a sense, a conjunction of long-term and near-term concerns. And what's interesting, and as the more seasoned of you in the room will be well aware, there's really a sense of déjà vu here. We've had this debate before. We've seen this debate before a number of times since the start of the Bretton Woods system. More or less every time the anchor economy, the US, runs into some sort of difficulty. And in most cases, except one, in fact, the debate went away without any significant changes to the system. But anyway, it's this time of the cycle again. Just to clarify what we're talking about, international monetary system relates to the official arrangements related to the balance of payments, exchange rates, reserves, regulation of current payments and capital flows. And as once observed by John Lipsky here, calling it a system at present is a bit of a misnomer. It is more of a free-for-all or a non-system, but nevertheless, let's stick to the convention. And as mentioned by John, I'll focus in this presentation on the particular angle of the international reserve assets, which, it's true, is only one corner of the topic, but will avoid repeating a number of points that were made in the previous session in particular. So I'll take you over some stylized facts, then discuss what's wrong with today's system, and then go over some solutions to the problems identified both on the demand side and on the supply side, that is, in terms of diversifying the supply for reserve currencies, and then I will offer some conclusions. So stylized facts, maybe, I suppose, in this audience, they're well known, so let me go quickly. There's been a very rapid rise in reserve accumulation over the last decade, largely driven by emerging markets, although not exclusively. The amounts have been pretty staggering, both in absolute terms, but also as a share of GDP, and interestingly also as a share of the GDP of the main reserve issuing countries. The level at which we are now, as was mentioned in the previous session, far exceed the traditional benchmarks, traditional prudential metrics of reserve adequacy, whether in terms of import coverage or in terms of coverage of short-term debt. The current data is really far above anything people deemed appropriate before, so clearly something else is going on. These holdings are massively concentrated. The top four holders hold about 50% of the total, and the top two holders 20%. I apologize that the country labels are wrong on this chart, but they're correct in the paper that has been circulated. Top two holders, of course, being China and Japan, and who among them hold about 40% of the total. And finally, last point that's relevant and worth noting is that these reserve holdings are predominantly concentrated in US dollars, a little above 60% of them. That's been going down over the last decade somewhat, but largely reflecting exchange rate valuation. effects. And this itself simply reflects an even more massive dominance of the US dollar in global international transactions, with the dollar involved in about 90% of global foreign exchange transactions. So what to make of all that, and why is it a problem? Okay, I've lost some animation here, but never mind. In a nutshell, the situation is that we have a seemingly boundless demand for reserves against a narrow supply. And this is a problem for a number of reasons. The first one is the sort of old Triffin dilemma reasserting itself in a new guise. Now, of course, the original conditions on which it was premised no longer exist. That was the dollar being fixed to gold and very little capital mobility across countries. The world today is different. Nevertheless, we have seen this old dilemma reassert itself in the sense of global demand for reserves being met essentially by accumulation of external deficits in the US, to a point where people start questioning their sustainability. This has been accompanied or facilitated, depending on which view you subscribe to, by the so-called exorbitant privilege, or simply the fact that this situation means the US can obtain financing at a lower rate than would otherwise be the case, and this arguably has led to more borrowing than would have been the case otherwise. Is it exorbitant? Well, not necessarily. This can also be seen as remuneration for global banking services, but nevertheless it's there. But more fundamentally, this situation reflects or leads to a system in which there is no self-adjustment of imbalances, in the sense that there is effectively no adjustment constraint on surplus countries. And while most deficit accumulating countries do face some adjustment pressures, there's at least one, the main reserve issuer, that face only very attenuated ones, which means that imbalances can pile up for quite a lot of time until they generate significant vulnerability in the system. So that's one set of concerns. The other is that because of the dollar-centric nature of the system, the stability of the whole system depends critically on the policies of the center country. And that's an issue for two reasons. One is, in a sense, the world is held hostage to the quality of the policies in the center country, which is one issue. But even if the center country never made any policy mistakes, there is always the possibility, in fact, perhaps even the likelihood, that in some cases policies that are appropriate for the center are not necessarily so for the rest of the world. And it's this conflict that can and has tended to lead to certain vagaries in the provision of global liquidity, which in turn has fueled a precautionary demand for reserves. So we're in a bit of a vicious circle. And to sort of illustrate or summarize the situation before going further into the solutions, the fact that we're trying to grapple with here is this massive reserve accumulation that's taken place over the past decade or so, concentrated in US dollars, which, not as a matter of necessity, but as a matter of fact, has contributed to undermine the two pillars of global stability, of the stability of the international monetary system, namely the stability of the global store of value and adequate provision of international liquidity. So this is an issue. This is an issue in itself. This is an issue also because it is costly for each of the countries that are engaged in these behaviors. But saying that is only part of the story, because this reserve accumulation is itself a symptom of more fundamental flaws in the system that would need to be fixed to deal satisfactorily with these behaviors. And here there's three types of problems. One is potential for overwhelming capital inflows to which emerging markets are exposed. The second one is uncertainty about the availability of international liquidity when these countries need it. And these two factors together add up to a precautionary demand for reserves. Then there's the lack of automatic adjustment for surplus countries, or the lack of adjustment pressures that I've already mentioned, which is the non-precautionary demand for reserves. And then finally, the issue that there is no adequate substitute for the dollar as key anchor in the system. So let me now turn to the potential solutions on all of these fronts, beginning with solutions on the demand side. How can we deal with precautionary demand for reserves? So let me first try to say, well, what part of the overall demand for reserves does this account for? Well, this is a hotly debated issue in some circles, and certainly I don't claim to have a final answer, but by the estimates we propose in this paper, which build on work by Maurice Obstfeld, around 2/3 of the stock of reserves at end 2008 was accounted for by precautionary motives, or about 1/2 of the accumulation in the last 10 years. It may be a bit more, it may be a bit less. In any case, it's not the entire story, but it's a good chunk of it, so it's worth trying to address it. And as mentioned by Olivier before, in principle, better alternatives would be either private insurance. The problem is there isn't much of a market there, or borrowing, and here there are options, but they're somewhat limited, and there is no true lender of last resort. So what to do? And in particular, what could the IMF do? Well, what have been the main hurdles up until this point to the IMF playing a greater role as an alternative to reserve accumulation? Essentially 3 types of issue. 1, uncertainty of access to financing when needed. 2, stigma, which is both a political issue and a market issue. Having to do with both the governance structure of the fund and the conditionality of its financing. And finally, the adequacy of the overall resource envelope. So we've been working on all these fronts already quite a lot, and more is underway in terms of governance reform, in terms of review of the adequacy of the size of the fund. But the part on which I'm going to dwell a little here is what we're doing or thinking about in terms of design of the fund's lending instruments. And there's various avenues that are worth looking at. One is to enhance the reliability of access to fund resources, for instance, by making more objective the qualification criteria for the different credit lines that are available. Another avenue is to increase the supply of unconditional resources, and again, there's different ways in which this can be done. Not all of them will be pursued formally by the fund, because clearly we also don't want to undermine the traditional lending facilities which are needed when there are adjustments, which are more appropriate when there are adjustment needs. And finally, we're also looking into new forms of support, such as guarantees that can better leverage the fund's resources, or assisting regional pools, which would be a way to get around potentially to get around the political stigma issues. Now, all this, however, is still trying to get at the symptom. Perhaps a more effective response is to try and get at the root of the problem and addressing the underlying volatility. And this is another area we're looking at in the context of the review of the fund's mandate, which is what can we do in order to provide better surveillance and maybe promote better regulation of global capital flows so that countries can better shield themselves from that volatility without needing so large reserve buffers. Turning now to the non-precautionary demand for reserves. I think it's important to distinguish 2 types. There's the consumption smoothing, intergenerational equity type of reserve accumulation, which essentially is self-reversing and which it's not clear we need to worry about from the standpoint of the global adjustment process. And then there's the reserve accumulation that is counterpart to export-led growth, which, as mentioned before, in principle is boundless. And here, the solution is fundamentally very simple. It's to try and find ways for the countries that engage in these policies to internalize the adverse effects on the system of the policies they're engaging in. There's different ways of doing that. In all the three cases, it's easier said than done. One is simple peer pressure, but that certainly should be tried, but it has its limits. Another would be to try and persuade all the key systemic players over time to limit intervention and move to floating. And finally, there's the idea that I think was mentioned in the earlier session of imposing penalties on persistent current account surpluses or deficits. It's tricky to think how this would be applied, but in all three cases, it's also very difficult to think why would any of the countries concerned agree to that unless they got something else out of the reform of the system. So hard to think we can go very far here in isolation, but maybe not so lofty if we also consider demands on the supply side. And this is where it gets into really lofty territory, but bear with me for a few more minutes. Before going into the alternatives, it's worth thinking, well, what would be a better system than the one we have? And here are sort of four criteria. One is, well, one that would provide better or more stability, more efficient adjustment mechanisms and lower volatility. Another criterion would be efficiency. The current system is pretty efficient. If possible, we don't want to lose that. The third criterion would be ease of implementation, and this both from a political standpoint and from an operational standpoint. The current system is extremely convenient in that regard, so beating that would be difficult. And finally, some, although perhaps not as critically as the others, but a sense of fairness to the extent possible is something that is a theme that does come up in some of the literature in any case among the criticism of the current system. So alternative number one, that's the simplest one. That's a true multiple currency system where there would be more national currencies broadly on a par with one another as main currencies, and possibly as secondary reserve currencies, some emerging markets, some prime emerging market assets to which some form of enhancer contenders in the near term, and those countries that or currencies that would be near contenders, such as the euro or the yen. It is not clear that the relevant authorities have any interest in giving that role to their currency, which would be a bit of a prerequisite. Secondly, one would need to overcome the network externalities that exist in the present system. And thirdly, it would seem that such a system would still provide a lot of scope for exchange rate volatility, perhaps not more than in the current one, but that's a tall order, but certainly no guarantee that there would be less. So it's a system whose feasibility is relatively high, at least compared to the next two that I'm going to present, but it's not clear that the benefits are so great that it would be worth sweating a lot to bring it about, at least on first analysis. So what would be a better system, potentially, is an SDR-based system. In other words, a system where the SDR, as envisaged in the IMF's Articles of Agreement, would become the principal reserve asset. And would also be the main currency of reference. So this system would essentially have the same benefits as the previous one, but in addition would offer a much more stable store of value and unit of account compared to to each of the components. Now the challenges, however, would be considerable. At present, there is essentially no market, no liquidity worth talking about in terms of SDR. So how do we create that from scratch? It hasn't really been done before, so even if we could map out a process, and there's certainly a number of ideas worth exploring there, it's not clear it would work. And for sure, it would take groundbreaking coordination among the key countries involved to get anywhere. And that in itself is a challenge. So the feasibility is fairly low in the near term. But having said that, an intermediate option would be to promote the SDR as one of many currencies in a multiple currency system, and this in itself would have benefits, and is perhaps an idea that is worth exploring further. Finally, the third alternative, clearly superior to the SDR-based system, would be one based on a global currency, which would be a new international legal tender circulating alongside national currencies. It would be issued by an international monetary institution, which would de facto function as a global central bank. The clear benefits is that for once there would be, if the issuance of that currency is properly handled, then the world would have a true global risk-free asset. There would be no exorbitant privilege, and even though this is something that would need to be looked at in closer detail, every reason to think that the adjustment process would be smoother. In addition, this is one setting where there would be a possibility of a true global lender of last resort. That said, as is, I think, fairly obvious, the political coordination needed to bring such a system about would be extraordinarily demanding. And it would also be pretty challenging to figure out what would be adequate issuance rules for such an institution, and what kind of governance structure would be appropriate to ensure that this process is well handled. So feasibility near zero, zero in the near or medium term. But should the world one day move to an SDR-based system, this would be a clear improvement upon it, and then perhaps something that would be less of a crazy idea. So conclusion, the current system is wanting. At the same time, it's clear that the solutions that I've identified are all, or for the most part, are pretty demanding, and also largely untested. So that would justify some skepticism before putting them in place. Does that mean there's no scope for change? Well, not completely. Left alone, the system is likely to morph very slowly towards some form of multipolarity. Is it going to be a better system or not? That's not clear. At the same time, I think what is probably a safe bet is that the appetite for reform will be commensurate to not only fears about the current ones, but also frustration. And it's clear that frustration about the current system is mounting in some quarters. And what's interesting is that countries want different types of change. Different countries want different types of change, but these are not mutually exclusive. And so it seems there would be some scope for quid pro quos between changes on the demand side and changes on the supply side. So I'll stop with that thought and leave it to the discussants. Thank you.